We could very well already be in a recession. Now is the time to prepare for this, to get ready to make your recession fortune. Because recessions have created more millionaires than lottery winners 10x over again, 20, 30x over again, because there's so many opportunities that come along if you have capital to invest during recessions. And I have to say, things are going to get a lot worse from here before they get substantially better. And I'll explain exactly what I'm expecting over the next couple of months for markets. But first, I want to just say this. There's a lot of people on Wall Street trying to justify the jobs report, the rise in the unemployment rate that we seen on Friday. Like, these guys need to just give it a break, give it a rest. The Fed has raised rates at the fastest pace in almost 50 years. Of course, there was going to be a day of reckoning. I've never been in the soft landing camp. At times, I will admit, at times, you have to start considering that as a possibility because things were so good for so long. But in the end, when the Fed raises rates and halts economic activity the way that they did and continue to do so, there is a day of reckoning for that. Higher inflation always leads to recessions. Not just because the Fed raises rates and slows down or halts economic activity in certain sectors, but also sticker shock. Has anyone on Wall Street been to a grocery store in the past year? Or do they just like get it delivered and don't even look at the statements? Because those prices are insane. They are way higher than they were, back in 2020 or even 2021 for that matter. And wages are not going to catch up to that for many years. So what does that mean? That means just simple math here. You have a deficit now, right? You're spending more, not bringing in as much. You're losing money. That's less money that you're going to spend on other things. So my point is, this day of reckoning was destined to happen, and it started on Friday. This is a start of a trend. This was not a start of a one-off instance of markets getting fearful over a recession. No, this is something that will be with us for many months. And let me tell you, there has been a lot of different banks and individuals, quote unquote experts, that have tried to justify Friday's data that we got. And it's laughable, okay? Dr. Ed Yardeni says the softer labor report is an aberration, heavily impacted by Hurricane Beryl and evidenced in the data. This is going to reverse in the coming months, and the Fed knows it. No, that's not true. It's just factually not accurate. Beryl did not have that large of an impact to cause the unemployment rate to go from 4.1% to 4.3%. It was not participation increasing that caused the unemployment rate to rise, or the labor supply that grew. That may have had some factor on this, but it's really people starting to lose their jobs. If you look at initial jobless claims that are starting to really show an uptrend and continuing jobless claims showing an uptrend, this was only a matter of time before we got a worse than expected non-farm payrolls report. And as JP Morgan said yesterday, it's possible we could actually go negative for a non-farm payrolls report or two this year. Just this year. This is the early stages of the recession. This is the denial phase. This is the phase where, things are not as bad as we think. They're going to get better. This was a one-off data occurrence. This is what happens every time you go into recession. The bulls call the bears doomsdayers and make a mockery of them, especially if we do get some good data here. But don't be confused. We are going into a recession to some capacity. Now, does this need to be an 08 style recession? No, it doesn't have to be that. Could it be that? It could. Is that my expectation? Not really. I think without a centralized catalyst, something really breaking, you probably don't get another 08. But over the next couple of months, I am expecting the data is going to get much worse and the odds of a recession will grow. Right now, I'm pricing the odds of a recession at about 10% in markets. That's judging where the S&P 500 is. That's judging where sentiment around a recession is. There's still very few people that are actually calling for a recession. People are starting to kind of get over the bull hump to say, maybe there is some weakening coming. Maybe there are some recession, quote, dynamics that are starting to show, but you don't have many individuals that are actually calling for a recession. And it's going to take some time. Economic data is lagged. I mean, the unemployment rate could be 5% right now, and we just won't know about it for months. That's the problem partly with a recession is by the time it looks like you're in a recession, you're already at least a couple of months into a recession. But delinquencies are starting to grow, especially for autos and on credit cards. And credit card debt is just spiraling out of control. At the same time, excess savings from the pandemic are gone. They're actually negative, over $250 billion. With inflation the way that it is, and I mean, you can say inflation slowed down. Sure, that's fine. I think we can all just feel inflation has slowed down, but the price level is still insane. I still have people that, complain to me that inflation is out of control, and I'm like, yeah, well, it's actually slowing down. It's actually a lot better than it was. People are like, prices are still going up. They're the same. And again, that's just a testament to wages that have not grown nearly to the same extent, not even close to the same extent as prices. Like government wages, the government data anyways, shows wages have grown about 16% from the pandemic until now. Inflation's up a little over 20% from the pandemic to now. But in all actuality, inflation is a lot higher than 20%. And wages are likely a lot lower than 16% growth on aggregate. So the point I'm trying to make here is really this was only a matter of time to begin with. We were eventually always going to go into a recession. It just happens to be that Wall Street got slapped in the face on Friday with some pretty recessionary data and also triggering the Sahm Rule. And speaking of the Sahm Rule, New Century's Claudia Sahm, the one that actually invented or created this Sahm Rule, went on CNBC and says, quote, "We are pointed towards recessionary dynamics."
Give us the latest you're thinking on not necessarily the rate cut question, but what's going on with the economy. Is it a recession?
We're not in a recession. When you look broadly across all the indicators, not just in the labor market, consumers, production, income, we are in a place where things have slowed. So we're not in contraction territory. That frankly is not good enough. We can do better than avoiding a recession. What is very worrisome, and today's employment report underscored, is the direction of travel. The momentum is not good. We are pointed towards what would be recessionary dynamics, and that should be a real wake-up call.
I think you put it best in your note on Wednesday, when you said the Fed should just go ahead and cut. And if they didn't cut this week, which they did not, you warned they might have to cut more rapidly in the meetings to come.
Yeah, I think it's pretty clear. And the Fed was very clear on the direction they're headed in, which is cutting interest rates. I think today calls into question the decision to wait, and yet they have what is so important and a cause for being somewhat optimistic is the Fed has a big lever still to pull, right? They have a lot of interest rate cuts that they could go through if they need to. They don't need to all at once, but we do have that lever to pull and take some pressure off the economy. This economy's in a good place. It just needs some pressure taken off it.
Diane, let me bring you in because you're now thinking that they're going to need to go ahead and quicken up the pace of cuts, right?
Exactly. We are looking at a 0.5% cut in September, and I think they're probably feeling a little remorse because they did discuss a cut. Chair Powell admitted at the press conference in July at the meeting in July. And so, having this number come out, triggering the Sahm Rule, I agree 100% with Claudia that we're not in recession. We still got momentum, but it is slowing. And I think actually the third quarter is going to be the weakest quarter out there. The good news is that the bond market is starting to do some of the heavy lifting for the Fed and already stimulating the economy by rallying and bringing rates down. What's also important is, I've sort of likened this that people forget how hard soft landings really are. I remember the mid 1990s, and it was a lot worse living it than it looks on paper. The path to a soft landing is similar to the path of gold. It is gold medal. It is paved with tears and setbacks and self-doubt. And that's clearly what the Fed's feeling today.
And I think people say we've only ever achieved one. So it's tough to do, Diane, to your point. Rick, let me bring you in here.
Well, I'd like to talk to Claudia about something very important. Claudia, the Fed has put a lot of credence in the stability and durability of the labor market, the strength in the U.S. economy. And my issue is that maybe the market signals aren't accurate. Seasonal adjustment, seasonality, commercial real estate, quantitative easing has masked many of the traditional historic signals. Just think about the yield curves and inversions and what they usually signal and how they may have been distorted by the huge amounts of QE. So, in order to understand if the Fed made a mistake or what they should do down the road, we need to know if the foundation that most of their policy has been built on was accurate to begin with, because many I've talked to don't believe in the intense, solid aspects of the labor market. Just look at JOLTS and some of the stale postings that they, for many months, kept referring to and maybe inflating job openings. What's your thought on the rearview mirror and the stability of the foundation before we even think about what we need to move forward to aid what looks like a very slow momentum issue with regard to the economy?
So we can't let the perfect be the enemy of the good. I mean, in terms of macro forecasting, macroeconomic policy, investing, I mean, this is really hard. We never have all the data we have. We always want that next data release. We always want that better piece of information. And so any decision the Fed is going to make they're going to have to make it under uncertainty. And this cycle has absolutely tested, I mean, the rules of thumb, the conventional wisdom. I get it. And the Fed has been in a really tough place. I think they have to pick their heads up and do some forward looking and make some decisions. But yeah, we're always going to be able to look back and say, well, they could have done this or that or the other. And I will absolutely affirm the point you made that the data picture, like our understanding of what is happening right now, is so very challenged. And what that means is, and I'll be the first to say it, having someone that has a rule attached to her name, don't just rely on one tool, right? You really got to open them up and think hard about where they disagree most.
So that was Claudia Sahm, the individual that created the Sahm recession indicator. And usually when that recession indicator is actually triggered, you are a month to 3 months actually already in a recession. And it's really just looking at the velocity of unemployment. So what you're getting now is the velocity, the pace of unemployment is starting to rise at a very fast rate. The problem with that is even if the Fed starts cutting rates today, it doesn't have much of an effect at all on the labor market. It's very, very hard to control the labor market when it starts to spiral. And that's why when the Sahm Rule is actually triggered, things tend to get a lot worse following that. But again, Wall Street is not going to come to this conclusion based on one data point that we are in a recession, that it's time to sell everything, it's time to hedge, it's time to go all in on cash again. That's just not how Wall Street operates. But if you can understand where we're going, you can profit from this. So as just a brief overview, let's take a look at what we have in store for next week. So ISM Services PMI, this did go into contraction last month. You came in at 48.8. We're expecting 51. So Wall Street's going to pay very close attention to any economic data, and specifically the services data. Services has been really the highlight of this economy. Manufacturing's been, in the toilets for 2 years now. Housing, commercial real estate, a lot of different areas of this economy have just been bad. Services has been the bright spot. Again, last month you were actually in contraction. Do we stay in contraction? I think is the big question. Does this number actually get worse? If it were to get worse, then you're going to have more recession fears start to get brought up. And this data comes out Monday at 10 o'clock in the morning. Now, on Tuesday, you get the balance of trade out of Canada, couple bond auctions, but that's pretty much it. Wednesday, you don't really have anything. You have consumer credit change, expecting credit to have went up about $10 billion. You do have a 10-year bond auction as well. And considering the drop in yields that we seen last week, that will also be important. Initial jobless claims. Every initial jobless claims that we get every single week, there's one a week, usually takes place on Thursday. The markets are going to start paying very close attention to this. Initial jobless claims and continuing jobless claims. This is the first leading indicator that we have to what's going on in the labor market. And we're actually expecting initial jobless claims to go up about 1,000 from 249,000 to 250,000. So any spikes here, really any week, is going to be seen as really negative for the economy and negative for the markets. And on Friday, you don't have much of anything as well, just the unemployment rate out of Canada. So next week's going to be a little bit on the slower side, as long as initial jobless claims do not come in bad or your ISM services PMI does not come in bad Monday, then you're probably going to see at least a short-term bounce here. I think we're going to go through waves in markets of, oh, we're going into recession, panic, fear, and then we get a good data report. It's not as bad. We can start to buy again. This is a great buying opportunity. And then we're going to get some more bad data, and there's going to be more panic, and then good data. And you're really just going to get this choppy volatility until there will be a moment in time. It's hard to say exactly, late this year, maybe early 2025, where everything just starts to look bad, where we don't get any good data. And we will come to that place. Again, perhaps it could be November, December, or it could be the beginning of 2025. And that's when you get the large decline in markets. Now, historically, what ends a recessionary environment? Well, in fact, it's usually when the Fed pivots to all out supporting the economy. 2008, COVID, early 2000s, almost like clockwork every single time. When the Fed comes out and says they will stop at nothing to ensure financial stability, that is when markets bottom. But from the point of recession fears starting to the point the Fed makes a commitment to protect the economy at all cost, that's where you get the downside. That's where you get all of the downside. After the Fed comes out and makes that statement, and by then rates are probably going to be at 0, if not sub 2% or so, the Fed might want to stop at like 1% to give themselves a little bit more room to cut to the downside. Doesn't matter exactly where federal funds rates are at that point. That's when you want to be fully buying the dip and capturing the opportunity. Now, obviously, it's okay to buy as markets are falling as well. And I think it's going to be pretty easy to tell, relatively speaking, when markets are about to bottom. And if you guys are subscribed to this channel, then I will let you know when you're getting close to the markets actually bottoming. I'm not a financial advisor, I'm not a fortune teller, but it'll be pretty relatively easy to see, in my personal opinion. Now, here is what you can do today to ensure that you are in the best possible position to take advantage of this crash, to potentially even get rich off of this next market crash. And really, it's a lot simpler than you would think. If you go out to eat once a week, twice a week, cut that back 50%. If you get your car detailed once a month, stop doing that. That's a waste of money. It just always will be. If you go on vacation twice a year, perhaps cutting out one of those would make sense. You understand what I'm saying? Cut down your expenses to the bare minimum. The bare minimum, not forever, just for a period in time. Make yourself as valuable as possible, not only for your job, but also doing side projects. If you're in construction, it's very easy to get some side jobs going. If you do landscaping, very easy to get some side jobs going. Even like a cleaning business, like anyone can do that, right? Go to your local businesses. Start trying to get word of mouth out there that you clean houses, male or female, does not matter. Try to cut some grass or do different projects. Do whatever you can do. DoorDash, for that matter. That is something every single one of you guys could do if you wanted to make extra money, as much money as possible. Now, you want to pay off debt as well, but actually I'm not a huge fan of that right now, and I'll tell you why. If you have out of control debt, of course, pay that off. But if you have reasonable debt, which I will assume that most of you guys have just reasonable debt, right? Nothing too crazy. Then I actually think just saving that extra money that maybe you would put towards principal otherwise in a normal time, principal on your debt, is the best idea. Just to save as much money as possible. Sure, you pay off your credit card debt, that's great. But that $10,000 theoretically that you pay off on your credit card, you can't swipe that and buy investments when that moment comes, right? You can do some other things, get some, that's never a good idea. You never want to buy anything on your credit cards anyways. I think we all know that. But I think the risk to reward right now makes a lot of sense, just saving as much money as possible. Because if we don't go into a recession, boom, then you can put large chunks away towards that debt that you're paying off now. If we do go into recession, you have a bigger, cash buffer, right? God forbid you lose your job or something. And best case scenario, you have a lot more money to plow into markets. That, I think, makes more sense right now, although you got to judge your own personal situation. It's always best to pay down debt as a generalized kind of concept. But at these moments, when you have a couple of months potentially of a heads up, like, hey, things are about to get bad here. Maybe there's going to be some really good opportunities to come, but I need some money to actually be able to seize these opportunities. Perhaps it makes sense to wait on some of those large debt payments. And I know that's going to sound so crazy. That's going to sound so kind of ass backwards, if you will. But that's what makes sense to me. That's what I would do likely in that kind of situation as well. So you want to save as much money as possible, cut back as much expenses as possible, and be ready to seize this opportunity. Again, I think it's going to be volatile. There's going to be a lot of ups and downs. I am expecting a near-term market bounce. The only thing that really matters here is the economic data. I don't think the Fed matters. I don't think inflation matters in terms of the markets. Like, are we really going to rejoice? Is it really going to cause a huge rally if inflation comes in low? I mean, the last 2 months have basically showed we're almost in deflation. I don't think inflation really matters if it comes in low or around expectations. Well, like literally the Fed said. Now, if it comes in high, then that's obviously a problem. You're talking stagflation, and that's not good. The Fed, we know what the Fed's going to do. We know the Fed's going to cut rates. Historically, the Fed cutting rates is not good into a weakening market. We know September 18th, historically speaking, could lead to a larger kind of downside crash event. It depends what the economy is doing, though, at that time. So I think the only thing that really matters in terms of moving the markets is the economic data. And I know that's also a hot take, saying the Fed doesn't matter, saying inflation data does not matter. It's all about economic data. Good thing earnings came in okay, because markets would be in a way worse spot if Apple would have butchered on earnings, let's say. We do have NVIDIA earnings coming up here in the next couple of weeks. That will also be important. From what we can tell, NVIDIA is going to report some pretty good earnings, though, so I don't think that's too much of a concern. Next earnings season could get a little choppier, and we'll obviously cross that bridge once we get there towards the end of this year. But that's personally what I'm doing. You know, getting a second part-time job right now makes sense as well. Makes a lot of sense. Just doing whatever you can to make as much money as possible. Because let's face it, there's not a lot of times in history where you have many months to prepare for this. It could be Q1 of 2025 when we go into recession, or when the markets start to price a higher odd of a recession, and then you see the larger crash. It could be 2-3 months from now. It could be 6 months. It could be 12 months from now. But it's coming. And I mean, during the Rona drop, nobody seen that coming, right? You didn't have time to prepare for that. 2008, I mean, nobody was expecting that to happen. The dot-com bubble, everyone was bullish. Hindsight, it's 2020. Some people obviously may have seen that coming, but everyone was pretty bullish at that time. These large crash events usually just happen. You don't normally get a heads up of them beforehand. And I'm here giving you a heads up about this event that could make you very rich, could make you very wealthy in a, I won't use the word wealthy, but rich in a very short amount of time. And now, will we V-shape kind of right out of a crash? When the Fed does provide the backstop for the markets, the Fed put, we will. We will rally something fierce. But from now until then, there could be a lot more downside. I don't think this is just a normal kind of environment. Considering, I mean, we are up 36% from 2022 lows. It is very possible we go back to the lows of 2022, if not even undershoot that a little bit. Maybe down to 315 on the SPY. You could see a 41% decline from here. That's why I think saving the cash, as much cash as possible, even not making extra payments towards debt right now, makes the most sense. Because we're not looking at a 10% correction. We're talking about a potential 40% crash. And if you fall 40% on the S&P, a lot of other stocks are going to be down 60, 70, 80+%. High quality companies at that. Dividend yields could be 10, 15, 20% on some of your dividend payers during that environment. Imagine that, right? Lock in 20%, 15% dividend yields on, some pharmaceutical names or something crazy. Like, that is real opportunity. And I think it's coming. It's going to take time. And that's why this video is beautiful, because it will take time and you have time to prepare for it. So let me know what you think about this down below in the comment section. Again, just to kind of throw this out there, I do think the election, we will see some volatility as well. Especially, we just don't know a lot of these policies or what kind of effect they will have, like tariffs, lower or higher taxes. We kind of don't know how Camila's stance is on all of this. So I think we will see more election volatility as well. But the main story, the entree is the economy at this point. The Fed, inflation data, politicals, geopoliticals, those are all sides, right, to your main entree, which is economic data. So that's what really matters here. Nonetheless, guys, I could probably go on and on forever about this topic. Let me know what you think about this down below in the comment section. Hit the like button as well as subscribe to the channel. If you guys want to come join the trading community, get some of these breakdowns first over there. Check out that link down below in the description of this video. Yeah, you guys have a great weekend. Hopefully this did not ruin your weekend too much. Hopefully not. Hopefully you see this as an opportunity, not something to be fearful or scared of. And I do just want to also acknowledge, I'm not selling any stocks also, right? I don't like the timing mentality of trying to sell, stocks, pay capital gains on that, or long-term capital gains potentially on stocks that I own, and then trying to buy back in, time the bottom. No, fresh cash I want to keep on the sidelines, accumulate as much of it as possible to be able to buy more or buy other stocks. I'm not selling Tesla. I'm not selling any of the other companies I own. Now, if I have a lot of profits on a company that I'm not convinced on longer term, then I would sell that. But that's a very small amount of my portfolio. So I figure that's probably worth throwing in here as well. This is not the video to say sell everything. Like that's I would never say to sell long-term stocks. I mean, why sell long-term stocks and pay 30% taxes when you can accumulate a portfolio and borrow against it at 3 to 5%? That's what rich people do. Do what rich people do, not what the masses do. So thank you for watching. You guys enjoy your weekend, and I will see you in the next one.